Hello, I'm Tony Kay. I'm the editor of Eureka Report, and I'm talking today with Callum Pickering, our economics writer. Hi, Callum.
Hi, Tony.
Let's talk about what's happening in the US with the Federal Reserve.
Yeah, so it appears all but certain that the Federal Reserve is going to hike rates when they meet on Wednesday next week. They're going to hike rates from 0.5% to 0.75%, so interest rates are still very low. But they're hiking at a faster rate than market analysts had expected, even as recently as a couple of weeks ago. Back then, market expectations for a hike in March were priced in at about 50-50. Today, it's almost 100%. So there's been a significant change there, owing to some of the strength in the US stock market, as well as some fairly favourable economic data that has flown through over that time. By comparison, it appears likely that the Reserve Bank is going to keep interest rates steady, both this month and in the foreseeable future, which creates an interesting dynamic there where we're beginning to see some tightening between government bond spreads in the US and Australia.
So for investors, what does it mean? The US rates going up, obviously, there's different outcomes in terms of borrowing and investing. What does it actually mean if US rates are going up, our rates are staying flat?
Well, what it does is it basically makes the US a more attractive destination for investment because you can get a greater return in the US now compared with what was the case a few months back. And that's likely to continue to be the case as the Fed goes ahead and hikes probably another couple of times this year. So in a relative sense, the US is now more attractive compared to Australia and other developed economies. And if Australia doesn't change their interest rate settings at all, that's likely to continue to be the case.
But there's a fair bit of catch up to do, isn't there, in the US compared to our rates?
That's right, and it's going to take some time before the US gets back to the level where Australia is now. That said, historically Australia has always required a little bit of a premium in terms of return in order to attract foreign capital flows. And so as the spread between government bonds in the US and Australia does begin to narrow, it will get to the point where investors say, look, you can get a higher interest rate in Australia, but given the safety of the US, perhaps we'd prefer to invest in the US instead, even though those returns are a little bit lower.
Yeah, Callum, we've seen over the last couple of months since the start of this year that the Australian bond market's been fairly active. A couple of banks have announced issues, and also some of the corporates have announced issues as well, sort of in that 4% sort of return range. And I'm just sort of wondering how that will compare against what's happening in the US. If US rates lift, what sort of impact that's likely to have?
Yeah, so the Australian banking sector has been pretty active in the corporate bond market over the past couple of years because they've been required to raise more capital to be in line with regulatory standards. The expectation is that this is going to continue, that the banks will need to continue to raise capital over the next 12 months. And given what's happening with the US, the fact that they will raise interest rates, that's going to increase their funding costs. And that means that there is a possibility that the corporate bond rates in Australia will also increase in line with that. So it's going to increase the funding costs for Australian banks.
So, Callum, in terms of the Australian dollar, what sort of effect is this likely to have?
Well, historically, when you narrow the spread between US and Australian government bonds, you see the Australian dollar decline. Now, we have seen that in recent years, though the Australian dollar has remained stubbornly high. But right now, the spread between the 2-year government bond yield in Australia and the US is at its lowest rate in about 15 years. And if it turns negative, as it did between 1997 and 2002, I think it was, we actually saw the Australian dollar drop like an absolute stone, where we had the Aussie dollar below 50 US cents there for a while. Now, I'm not necessarily suggesting that would happen, but as that spread does continue to narrow, we are likely to see a significant drop in the Australian dollar, where it becomes quite a possibility that the Australian dollar will be below US 70 cents and possibly well below that level over the next year or two.
Which is what the Reserve Bank's been aiming for quite a while, to get the Aussie dollar down.
Yeah, the Reserve Bank's happy that the Federal Reserve is sort of doing its job for it. If the Federal Reserve is a little bit more aggressive than expected, then the Aussie dollar is going to take that hit, and it's going to get down to a level where it's going to become much more easier for manufacturing and other trade-exposed sectors in Australia to compete globally.
So, as always, there's a lot of dynamics at play in global markets, and we'll be watching with keen interest as to what happens with US rates over the next month or more.
Yep, that's right.
Thanks, Callum, for joining us. We'll see you again next time.